Welcome back, everyone. Today, we're diving into one of the most influential books on investing ever written, The Intelligent Investor by Benjamin Graham. This isn't just a guide to the stock market, it's a philosophy that teaches us how to make smart, disciplined financial decisions and weather the unpredictable world of investing. Let's break down each chapter so you can walk away with the core principles of this timeless classic. Whether you're a beginner or a seasoned investor, there's something in here for everyone. Let's get started. Chapter 1. Investment versus Speculation. In Chapter 1, Graham draws a clear line between investing and speculation. Investors look for stability and long-term growth, while speculators chase quick profits without considering the risks. Graham warns that speculation, while exciting, often leads to losses and heartbreak. This chapter sets up the core principle of the intelligent investor. Invest patiently and intelligently, rather than gambling. Graham advises us to know our goals and to avoid the allure of short-term gains. Think of investing as owning a piece of a company, not as a series of transactions. Chapter 2. The Investor and Inflation. Inflation is the silent thief, slowly eroding the value of your money. In Chapter 2, Graham explains how inflation impacts investments, especially fixed-income assets like bonds. While stocks can provide a hedge against inflation, they are still subject to market risks. Graham suggests diversifying your investments to protect yourself. His advice? Consider a balance of stocks and inflation-protected assets. This chapter reminds us to view inflation as a constant threat and encourages us to plan our portfolios accordingly. Chapter 3. A Century of Stock Market History. This chapter offers a fascinating look at the stock market's history from the early 1900s to the 1970s. Graham takes us through the market's ups and downs, showing patterns and lessons from each major event, like the Great Depression and post-war booms. He emphasizes the importance of understanding market cycles. Periods of optimism are usually followed by corrections. The lesson here? Don't get too comfortable in a bull market and don't panic in a bear market. History shows that markets fluctuate, but patience and discipline win in the end. Chapter 4. General Portfolio Policy for the Defensive Investor. In Chapter 4, Graham introduces the concept of the defensive investor, someone who wants stable, low-risk investments. He suggests a balanced approach of 50% stocks and 50% bonds, adjusting based on market conditions but never straying far from this balance. For defensive investors, simplicity is key. Choose well-established companies with a history of stable performance. The message here is that defensive investing is about protecting your capital, not chasing high returns. The goal is to maintain a steady growth without excessive risk. Chapter 5. The Defensive Investor and Common Stocks. Continuing with the defensive strategy, Chapter 5 explores how to choose stocks wisely. Graham advises looking for established companies with consistent dividends and moderate price-to-earnings ratios. Avoid speculative stocks and focus on companies with a solid track record. This approach requires patience, as defensive investing is about stability over excitement. Graham emphasizes that quality and stability are more important than the potential for quick gains. Invest in businesses you believe will be around for the long haul. Chapter 6. Portfolio Policy for the Enterprising Investor. Moving on to the enterprising investor, those willing to take on more risk for potential gains. In Chapter 6, Graham outlines strategies for this type of investor, including bargain hunting, special situations, and investing in undervalued stocks. But he cautions that this approach demands more knowledge, time, and emotional discipline. This is where the line between intelligent investing and speculation can blur. Graham encourages enterprising investors to stick to fundamental analysis and avoid emotional reactions to market swings. Chapter 7. the enterprising investor and common stocks. Chapter 7 builds on the enterprising approach by outlining how to pick individual stocks. Graham suggests looking for companies with strong financials, low debt, and a record of consistent earnings. He introduces the idea of bargain hunting for undervalued stocks, companies whose stock price is lower than their intrinsic value. This method requires more research and expertise, but can yield higher returns. However, Graham warns against getting attached to stocks. Always be ready to sell if they no longer meet your criteria. Chapter 8. The Investor and Market Fluctuations. This chapter is one of the most critical. Chapter 8 teaches us how to handle market fluctuations. Graham introduces the concept of Mr. Market, a metaphorical character who offers to buy or sell stocks at different prices every day. Mr. Market is unpredictable and often irrational, but the smart investor remains calm and takes advantage of his mood swings. Graham emphasizes that market prices are often driven by emotions rather than fundamentals. Our job as intelligent investors is to remain patient and not be swayed by panic or excitement. Chapter 9. Investing in Investment Funds. In Chapter 9, Graham discusses investment funds, including mutual funds and index funds. He cautions that many actively managed funds underperform due to high fees and managers chasing trends. Graham advocates for a more cautious approach, preferring low-cost index funds as they are diversified and have lower fees. The takeaway? For most investors, especially defensive ones, index funds offer a simple, cost-effective way to get broad exposure to the market without the risks of active management. Chapter 10. The Investor and His Advisors. Chapter 10 delves into the relationship between investors and their advisors. Graham stresses the importance of finding advisors who align with your goals and are genuinely interested in your success, not just making a commission. A good advisor should educate you, help you avoid speculation, and support your long-term goals. Graham warns against blindly following advice and encourages investors to stay informed. After all, no one will care about your money as much as you do. Chapter 11. Security Analysis for the Lay Investor. This chapter introduces basic security analysis, breaking down how to evaluate a company's financial health. Graham explains key financial ratios, earnings, and balance sheets, making it accessible even for beginners. He advises focusing on well-established companies with strong financials. For most individual investors, he suggests a high-level approach, aiming for sound fundamentals rather than complex analysis. The message here is that you don't need to be a financial expert to make smart investment decisions. Chapter 12. Things to consider about per-share earnings. In Chapter 12, Graham warns against placing too much emphasis on a company's per-share earnings, as these can be manipulated or misleading. Instead, he advises looking at a company's long-term earnings record, its business model, and industry position. Graham wants investors to look at the big picture rather than obsessing over short-term profits. By focusing on fundamental strengths, investors can make more informed decisions and avoid the trap of hype. Chapter 13. A comparison of 4 listed companies. In Chapter 13, Graham gives us a hands-on lesson in evaluating companies by comparing 4 real-life examples. He takes us through key financial metrics like earnings, growth rates, and dividends, highlighting the differences between them. Graham's analysis focuses on how to recognize signs of stability versus risk. Some companies have strong earnings and growth potential, while others might look good on paper but show red flags upon closer inspection. This chapter is a deep dive into practical analysis, teaching us that not all companies are created equal. The goal is to understand a company's real value beyond surface-level numbers. Chapter 14. Stock Selection for the Defensive Investor. Chapter 14 returns to the defensive investor, laying out specific criteria for selecting safe and reliable stocks. Graham suggests focusing on large, established companies with a long track record of profitability, moderate price-to-earnings ratios, and stable dividends. He recommends avoiding speculative growth stocks and sticking to companies with a strong financial position. For defensive investors, diversification is also key, holding at least 10 to 30 well-chosen stocks to reduce risk. This chapter is essentially a checklist for conservative stock picking, reminding us that quality and consistency are the foundations of a sound portfolio. Chapter 15, Stock Selection for the Enterprising Investor. Chapter 15 shifts focus to the enterprising investor, who is willing to take on more risk in exchange for potentially higher returns. Graham outlines strategies for identifying undervalued or overlooked stocks, like small-cap companies or those with temporarily low prices. He advises paying close attention to companies with low debt, strong earnings, and good growth prospects. Graham warns that the enterprising investor must be disciplined, avoiding emotional decisions and focusing on hard data. This chapter empowers more adventurous investors to seek out hidden gems in the market while still following sound principles. Chapter 16, Convertible Issues and Warrants. In Chapter 16, Graham introduces the concept of convertible securities and warrants. Convertible bonds and preferred stocks offer the stability of fixed income assets with the potential to convert into common stock if the company performs well. Graham explains that convertibles can offer both safety and upside potential, but they also carry unique risks. Warrants, which give the holder the right to buy stock at a set price, can be highly speculative. Graham advises approaching these securities with caution, particularly for defensive investors, as their value can fluctuate significantly based on the underlying stock's performance. This chapter broadens our understanding of investment vehicles, showing that every choice carries its own risk-reward balance. Chapter 17, for extremely instructive case histories. In Chapter 17, Graham presents 4 case studies of companies demonstrating real-world applications of his investment principles. He analyzes each company's financials, market position, and overall stability. By examining the successes and failures of these companies, Graham illustrates the importance of thorough research and critical thinking. Some companies that seem like great investments turn out to be risky upon closer inspection. This chapter reinforces the need to dig deep and avoid assumptions based on hype or surface-level numbers. It's a reminder that a smart investor looks beyond appearances to truly understand a company's value. Chapter 18, a comparison of 8 pairs of companies. Chapter 18 offers a side-by-side comparison of 8 pairs of companies, each from the same industry, but with different financial characteristics. Graham contrasts these companies to highlight what sets strong investments apart from weak ones. Some companies have strong fundamentals, while others are overpriced or overleveraged. This comparison reveals how, even within the same industry, 2 companies can present vastly different risk profiles. Graham encourages us to be discerning, comparing financial data and market trends to make better informed decisions. This chapter teaches us that not all stocks in a sector are equally promising. It's about finding those that stand out with solid fundamentals. Chapter 19, Shareholders and Management's Dividend Policy. In Chapter 19, Graham delves into the often debated topic of dividends and their role in an investment strategy. He explains that a company's dividend policy reflects its financial health and management's commitment to shareholders. Companies with a steady dividend history are generally stable, reliable, and shareholder-focused. However, Graham also notes that some companies might retain earnings to reinvest in growth, which can benefit shareholders in the long run. The key takeaway: dividend policies offer insight into a company's values and goals, and investors should assess whether a company's approach aligns with their own financial objectives. Graham's balanced view reminds us that dividends can be valuable, but they're just one piece of a larger picture. Chapter 20, Margin of Safety. The final chapter, Margin of Safety, is Graham's golden rule. The margin of safety is the difference between the stock's price and its intrinsic value, essentially a buffer that protects investors against errors or market downturns. Graham believes that by buying undervalued stocks, you create a safety net that shields you from risks. This is where the intelligent investor truly stands apart from the crowd. The margin of safety is what allows you to invest confidently, knowing that even if things go wrong, you're protected. It's the essence of intelligent investing. Closing script. So there you have it, the timeless lessons from the intelligent investor. From defining the difference between investing and speculating to mastering the art of margin of safety, Graham's advice has shaped countless investors. Remember, investing isn't about quick wins. It's about patience, discipline, and a commitment to understanding the market. Thanks for watching, and let's continue making intelligent investment decisions together. See you in the next video.